Hello, everybody. Jason Zickerman here. Welcome to the Leadership Exchange, where we have candid conversations with forward thinking leaders who are shaping the future of business. Again, my name is Jason Zickerman, and I just want to tell everyone this is a podcast for business leaders by business leaders. And I just am so excited for today's podcast. Today, we're talking about a shift that's quietly changing the way business owners think about the future of their companies, because there are young, ambitious entrepreneurs who are approaching owners directly to acquire their businesses. A trend called entrepreneurship through acquisition, or a lot of people refer to it as ETA. Today, our guest, John Warrillow, who I am just so excited to have here with us. He's been a friend and a colleague over the years, and I'm just so grateful he's taken the time to chat with all of us. He's the founder of the Value Builder System, a platform that helps business owners and leaders understand how to grow the value of their companies. He has dedicated his entire career to helping leaders think more strategically about the value of their business, the buyers, and what it takes to build a business that lasts. So, John, thank you. Really, sincerely, welcome to the Leadership Exchange. So glad to have you here. How you doing?
I'm good, man. It's great to be with you again.
Yeah, I appreciate it. So, John, this is going to be a very interesting topic. You know, when we start speaking about it, I have to be very candid. It was newish to me as well. So the fact that you're here to help share this trend is really, really very, very appreciative. You know, John, you spent over a decade now helping business owners grow their companies and prepare for the future. You've created the Value Builder System. You wrote multiple books on the topics. You're helping business owners think differently about growing their existing companies. Can you share with me a little bit about how your work and your thinking has evolved over the years and about exit readiness for business owners?
Hmm. Yeah, I wrote a book called Built to Sell back in 2011. And at the time, the reaction, and Jason, you may have had this reaction too. I can't remember when I first chatted with you about it, but the reaction was one of two kind of buckets. There was a group of people who saw the title and said, yeah, get it. Immediately, building to sell, completely on board with that, get it. And then there was another group, probably of equal size, who kind of had a squeamish reaction to it. It was like, ooh, that sounds kind of Silicon Valley ugly, and the whole kind of built to flip mantra, and aren't we supposed to be building to last, and the idea of generational companies that lasting multi decades, and this idea of building to sell is kind of dirty and money grubbing. And I would say, I'm guessing it was probably half and half in terms of the reaction back in
Yeah.
2011. If we flash forward to 2026, I would say that's changed. I would say the majority of people I speak to are now in the built to sell camp. They're much more forward thinking about exit readiness. They have an end game in mind, and the minority of people are questioning that idea. But it's probably gone from 50 to 50 to 90-10 now. So
Why do you think that is, John? Why do you think that the mentality of business owners shifted in that direction? Because I agree with you completely, but I'm curious why you think that shift happened.
yeah, I think if we go back 100 years, businesses, the father had the moving company or the bakery, and he would, I mean this to be specific by gender, he would literally pass the business on to his eldest son. Like that was how kind of patriarchal we were 100 years ago, right?
You're right.
And then, obviously the world has changed dramatically since then, and today's entrepreneurs are much less patriarchal about their companies. They're not thinking of their businesses, at least in my experience, as these forever jobs for people that you get the gold watch after 50 years in service. That's not what the employees are expecting, nor is it that the founders are offering in many cases, right? So founders, I think, are taking a different approach to it, and so we see this generationally. Like as you might imagine, older business owners, they're a little more likely to still say they might pass their business on to their kids, but younger business owners, the last number I looked at was 6 in 10 business owners plan to exit externally, so to a third party, private equity,
Right.
ETA, et cetera. Whereas, that's changed over the last few decades.
Well, it's very consistent with our research as well. You know, when but more specifically, family businesses, I would say that we always tell people that a family business that makes it to the third generation, or certainly past the third generation, we call a dynasty, because it's so rare to see it actually survive that. So I could see maybe the fact that it's the likelihood of it getting passed on generation to generation lends itself to say, hey, maybe we should think about it differently. Yeah, very interesting insight, and I totally agree with what you're saying there. So before we get into this ETA type of scenario, when we were talking the other day, just kind of discussing what we might discuss on the podcast, you mentioned something pretty interesting to me. You shared some research that you're doing now, and I understand it's preliminary findings from your side of things, from your most recent Value Builder survey. And you shared with me that business owners who are early adopters of AI and bringing AI into their business are having what appears to be a different level of selling success uh, with their business. And now you did push back on me. You said, Jason, I don't really think this is causation, but there's something going on with the AI that I thought, before we get into the other stuff, just you mind touching on that? Because I think
Yeah,
the
yeah, no
audience would really
problem.
like to hear about it.
Yeah, in the fall of 2025, so about 4 months ago, we added a question to the Value Builder questionnaire. Value Builder questionnaire is a questionnaire that business owners use to assess the value of their company. We added the question, which of the following best describes your attitude towards AI? And we gave them a range of options from, on one hand, it's not relevant to us at all. We have no plans to adopt it, to, on the other end of the spectrum, like we're using it already in 3 or 4 areas of our business. And we have various sort of options between in that spectrum. And what we did was analyze the enthusiasts, the AI enthusiasts who were on one end of the spectrum, with the AI skeptics who are on the other end of the spectrum. And we looked at all of the rest of the sort of data we gathered through Value Builder, and we found a really interesting trend. And you were alluding to it just a minute ago. That is that the AI enthusiasts were much more likely to be growing companies. So both the industry that they were in, as well as their company itself within it, were growing. They were more likely to have recurring revenue, which is that secret sauce for driving up the value of a business. They were much more likely to have a platform, which is kind of a personal brand that enabled them to kind of scale their business beyond what the AI skeptics could do. And then when it came to valuation, they were getting offers about 25% higher than the AI skeptics. Now, I think it would be a mistake to infer causation in that, as we just talked about, in that I don't think it's because they're adopting AI that they're getting higher values. I think it's an attitude that they are growth oriented. They're adopting new technology. They're leveraging themselves and other pieces of technology in their business. They're kind of open to new ideas, recurring revenue as a billing platform, et cetera, as a billing methodology, et cetera. That all of those combined are leading to higher offers. So it's an interesting canary in a coal mine if you think of it that way.
I do. I mean, look, at the end of the day, also, as I talk to a lot of business owners, because you can't be in a business meeting anymore without someone saying AI, this, that, and all that. But look, I tell people, get on board, start digging into this, because it's not a fad. It's here, and it is massive in what it can do and will be doing. So the sooner you get involved, better. So I could totally see why that's happening. But that's really interesting research. And as you continue with it, please keep us informed, because I think
Yeah,
that's a
we should.
fantastic way of going.
Yeah, let me give a quick plug for Tab as well, because here's what I've learned about AI adoption. I find that business owners are going through this, what I call the AI grief cycle. The AI grief cycle it starts very optimistically. It's like the first time you saw AI, and like the first time you saw ChatGPT, you like type something, I can't believe they'll make a poem or a song, or like, now they make pictures and videos. Like
Right.
it's an incredible, like, oh my gosh, this is amazing. How could we leverage this in my business, my personal life, etc. So there's this kind of euphoric moment. And then there's this quick drop where you realize, oh, wait a minute, not only do I have access to this, but my competitors have access to this. And not only do my competitors, similarly capitalized, have access to, but so do the smaller businesses and the startups and the kids that are still in school dreaming about business in my category, my industry, also have access to this. And there's this kind of overwhelming feeling for a lot of business owners, like trying to catch up, or, you're treading water and you're starting to lose yourself below the waterline. And then I think the final stage in this AI grief cycle is when we retreat to the real world, where we all have this inclination to become skeptical of digital communications, become skeptical of AI fakes and fake videos, and we become much more focused on physical face-to-face relationships. And so again, I think this is the magic of getting out of the office. I think being in a tab board, getting face-to-face with your peer group, getting face-to-face with people in your community, I just think it's going to go parabolic in terms of importance, because as we become more digital as a society, our craving for face-to-face, I think, is just going to become much more pronounced. And I almost see it. This sounds kind of goofy even saying it, but I feel like we're going back to the 1990s. I feel like we're going back to, hey, let's grab lunch and talk about that business idea. Come to the game. I've rented a box because I'd love for you to meet some of my other customers. Again, I know that sounds antiquated for people listening, but I think
it doesn't sound antiquated to me, John, because I tell you something. What I just gave a talk, and when I was explaining, I said, look, AI is something that you have to engage. Not only do you have to engage, I was talking to a bunch of business owners, you can't delegate this to your IT people. The CEO, the leader of that company, must be someone who helps lead and throws their energy behind it. I said, but at least with Tab, what we're doing is we have to double down on what makes us human, our presence. We see potential. We care. That doesn't happen with the AI. And that's going to be a really needed support. So I agree 100%. With you completely.
Yeah, no, I'm excited about it. And I think you're absolutely bang on.
Yeah, fantastic. So let's get into this thing, because I'm fascinated by it. But before we get into the ETA, when we chatted, you mentioned that there were really three main types of buyer, or at least three, but you talked about strategic buyers, you talked about private equity groups, and then you talked about this newish type of area called ETA buyers. Can you just give a brief explanation of each of them and what type they are and what they're typically looking for in a company, so we just kind of set the table?
Yeah, for sure. So a strategic acquirer is buying your business for what it's worth in their hands. So think of the company where by adding your product or service, they can compete better with their rivals, et cetera. So strategic acquirer is usually a much larger company. They're oftentimes in your industry, in your ecosystem, maybe a competitor, maybe a supplier, maybe someone, a partner, et cetera. That's a strategic acquirer. Typically, although of late it's changed a little bit, typically the strategic will pay the most for your business because they've got some strategic value proposition, some strategic thesis. The second group, and I think every listener to this podcast will have had somebody knock on their door recently from a private equity group. These are financial engineers. They are buying low and selling high. They're effectively going to try to buy your business at a low multiple, stitch it together with other businesses like yours, and sell the collection for a higher multiple. When it works, it can be tremendous because you typically will roll some equity, which means that they will take a majority position in your business, 60, 70, 80%, and you will roll or become an investor, minority investor in their entity. And your 20%, if you roll 20%, for example, gets the benefit of all of the additional premium they get when they go to sell their business. So if they buy you for 5 times EBITDA and they go on to sell the collection of 10 times, well, that percentage that you rolled has doubled in value. I'm simplifying it, but effectively that's private equity buyer.
Right.
And they are very, very, very acquisitive in a lot of industries. So you'll know if you're in an industry that's being rolled up by private equity because you're getting phone calls all the time. So HVAC, plumbing, dental practices, et cetera. That's the second and most common acquisition acquired today. This third group is called ETA buyers. It stands for Entrepreneurship Through Acquisition. And these are individuals who would like to own a business. And instead of starting a business, which has tremendous risk associated with it, they are choosing to buy a business. And 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 so that's a different type of buyer. And it's being fueled by the big universities in America. So in the United States, I believe it was Harvard, maybe Stanford was the first to really pioneer the ETA degree. And so, but today, many of the big universities in the United States offer this thing called an ETA MBA. So it's an MBA with a specialization in entrepreneurship through acquisition. And so they're training an army of young MBA grads on how to buy businesses. And so that's creating quickly a very large cohort of new buyers for small businesses. And so if a tab member has not received a phone call from an ETA buyer, I'm going to tell you that in the next year you probably will, because there's a big growing army of these folks looking for a deal to buy, a business to buy.
So as you think about these ETAs, what have you noticed about these particular buyers? And how are they influencing or should they be influencing the way owners think about their future and potential exit? Who should be thinking about it? Because it's not for everyone, I'm assuming, but what are you seeing in that regard?
Yeah, it's interesting. The ETA buyer is often buying an unloved, quirky business. And it's in part because there's less competition for those businesses. If you think about a private equity buyer, they've got a thesis. I did an interview with a guy who's buying garage door companies. So like they've got a bunch of private equity money and they're trying to roll up garage door companies, right? So great, successful business, but there's a very specific thesis they've got. Whereas ETA buyers are less specific around the industry that they're buying. And because they're generally paying lower multiples, they can't compete for a deal, right? So if you're a business in a quirky industry that's not really going to be terribly strategic, maybe you're not large enough, maybe you're 2 or 3 million in sales, maybe 5 million in sales, you're not probably big enough to get the attention of a strategic acquirer. You're not in an industry that's getting rolled up. And so what are you left with? Well, you're left with these ETA buyers. So, I was trying to think of an example for you. Like imagine, like a caretaker, a janitor in a high school will have a mop and they'll have sawdust, and it's like oily sawdust that they'll, go around and try to clean up the cafeteria. Like if you're the guy who sells the sawdust and there's like 2 of you in the country, you're not going to be interesting to a private equity group. You're probably not a strategic acquisition, but you may very well be very attractive to an ETA buyer who wants to buy themselves a job effectively. They want to be a founder, they want to be a CEO, but they've chosen this purchase. So you're in a kind of a quirky industry. And so on balance, Jason, I think it's a good thing that ETA buyers are out there because they're giving liquidity, they're giving options to businesses that frankly may not have had a lot of options to sell in the past.
Interesting. Yeah.
But there are some things to be mindful of, some pros and cons, but in general, I think it's generally a good thing.
So I'm sure there are. That makes sense. So this rise of ETAs, should it be impacting the strategy? Does it impact timing for a business owner? Is there some sort of way that a business owner should be looking at it, knowing or first learning possibly about this new avenue of buyer?
Yeah, it's a great point. So the first thing is to be bankable. What do I mean by being bankable? A bankable business is a business that an acquirer can borrow money to buy. A bankable business is a business that has profits, has cash flow, is predictable, i.e. has some recurring revenue or contract or something that a bank would look at your business and say, yeah, I'll loan 40% of the value of this company, because that's the way an ETA buyer gets the money to buy your business. So you can imagine they've just come out of Harvard with $200,000 of student debt. They don't have a lot of liquid cash. So how do they cobble together the money to buy a business? Well, the first tranche is their own money, but it usually is not much. It's usually a few, like 10, maybe $100,000, but like not a lot of money in the grand scheme of things. Then they're going in the United States to the SBA, Small Business
Yeah.
Administration loan program, where they're borrowing money. They're signing a personal guarantee to borrow money. And the SBA will do that deal if the business that you want to buy, in my case, the sawdust company, is bankable. It's got profits and recurring revenue. And the SBA will say, yeah, we'll probably loan you 40 or maybe 50% of the value of that company. So then they've got like half of the equity they need. Then they go to the seller and ask the seller to take their money over time. It's effectively vendor financing, where they say,
Carry the paper on it. Yeah.
yeah. So instead of, let's say your business is worth $5 million, and they might say, look, we'll give you 3 million up front, but take the 2 million over the next 5 years. I'll pay you, $100,000 a month or whatever it is to get to the finish line. So that's the way they typically structure these deals. A little bit of their own money, a bunch of money from the SBA, and then usually a chunk from the actual seller themselves.
Really interesting. So you talked about these programs that they're being trained, Stanford, Harvard, whatever it might be. Any insights into what you've learned about these programs and what they're teaching them to do and what maybe they should expect when they're being approached by a first-time buyer?
Yeah, and this comes to a little bit of the caution that I would have around ETA. And again, at Value Builder, our goal is to level the playing field for business owners. So we're squarely in the business owner camp here, where that's who we advocate for. And that is that they train these ETA buyers to get a seller under LOI, after which time they try to raise the financing to buy the business. What do I mean by that? So when you go to sell your business, the buyer will give you a letter of intent, and that's going to include what's called a no shop clause, which is basically a period of time where you cannot negotiate with anybody else. You're basically getting engaged to this buyer. And as you might imagine, you lose a lot of negotiating leverage when you say, okay, we're gonna get engaged. You have no ability to kind of drive up the price, drive the deal terms, get other people interested. Once you sign that LOI, you're kind of committed, and your negotiation leverage goes from one end to the other end of the spectrum.
Well, let me ask a question, because that's a little different, at least in a lot of the deals I've been privileged to be around. Most LOIs are not binding. Are these typically binding LOIs?
No, they're not binding. It's just that what is binding is that you can't shop your business. That commitment is firm.
That's true. Right.
But any party, both buyer and seller, can pull out of an LOI, provided it's non-binding, and it usually is. And so you can pull out of it, but you are effectively breaking up the engagement.
Well, yeah, because you're agreeing that this is what we've agreed to in the key commercial terms. You're not going to renegotiate, right? Okay.
Exactly. So that's all fine and good if you take it on its face. Where I get a little concerned around ETA is these buyers, these students, graduates, are locking business owners into LOIs without necessarily the ability to raise the money. And so they then go hat in hand to a bunch of people to try to get them to fund the deal. That can take many months for banks to say, yeah, we'll do the deal, for other investors to say, yeah, we'll do it. And all that time, the business owner is losing negotiation leverage.
It's off the market. Yeah.
Market changes, anything happens. Yeah.
So, which really is important for us to discuss here. So, there's going to be a certain percentage of our audience who say, you know what, this ETA actually is an option that I didn't know about.
Yeah.
And it makes good sense for me to be looking at this. So what if you feel that your business is the right type of business for an ETA buyer? Is there something that those folks should be preparing, that how they prepare to talk to an ETA buyer? What are some of the things that they need to do preparing for that? Because it's different for private equity, for sure, type of thing. And for those who get involved in that, it's a very different type of process that's for many is unpleasant. But in this particular case, preparing for an ETA, different from other types. What should they do to prepare?
Yeah, I mean, look, recurring revenue is going to make your business more bankable. So that's obviously a good thing to do strategically. You might think about doing a quality of earnings, hiring an accounting firm to do a quality of earnings. That's really where they go in and do kind of a mini audit of your business and confirm that what you say you're doing in terms of revenue and profitability. Oftentimes that's funded by the buyer, but it can accelerate if you think you're committed to the ETA route. It can accelerate the whole process and verify your financials for a potential acquirer. I think on the flip side, there's a two-way due diligence that you've got to do here, right? So on one hand, they're doing diligence on you to evaluate like your business, do they want to buy it, et cetera. But as I mentioned, like you're kind of risking a lot as well in these deals, and so I think doing some reverse due diligence. Look, it can be quite intoxicating for someone to say, "I want to buy your business," especially if you've been slogging away for 30 years, and some slick Harvard grad says, "Hey, I want to buy your business." It can feel really good and flattering to have that, but once you kind of peel away that sense of elation that you might feel to feel wanted, I think it's important to then get into, okay, who is this person? Do they have the money to close? What are their relationships? What does this look like? Have they done this before? And really kind of pressure test that, because again, once you sign that letter of intent, unfortunately, the negotiation leverage is going to go away, and that's when you're kind of in there at their mercy to some extent. So you want to make sure in that negotiation phase you're doing two-way due diligence.
It's excellent advice, and so I hope the audience pays attention to what you just shared there. So when you think about the ETA buyer and the seller, is there something in deal term structure or anything that they need to have with alignment with the buyer or long-term impact on the business? What are some of the big things from a
Yeah.
seller's standpoint that they should be definitely thinking about? You touched a little bit on a couple of it, but tell me what you think.
Yeah. So look, I really like ETA again, especially for quirky businesses that don't have a lot of options with private equity. I think it's a really cool thing. So again, I don't want to sound like I'm negative. I'm not. I think it's a great option. One of the things, if you put yourself in the shoes of the buyer who's just gotten educated at Cornell or Stanford or some fancy school, they have a thesis. They think that they can make your business more valuable, more profitable, effectively, right? By professionalizing it, using some of the theories they learned at school and in some cases, in many cases, they will do that, right?
Yeah, right.
And there's room to improve. Know that that is their thesis, that it's not like they're buying your business to keep it exactly the way it's running today forever, right? So if you're a seller, I think you do have to come to terms with the fact that an ETA buyer will make changes. They are going to, quote, professionalize your business. That could mean that if you've had Marge in AP since 1986, Marge is going to get fired. Like that's the reality, right? Like I hate to be as crude and brutal as that, but that's realistically what's going to happen. So although they train ETA buyers not to make any dramatic changes in the first 6 to 12 months, you can bet if they're buying the business, part of the thesis is we're going to improve it. And so improving it by its nature means they're going to take a policy, a decision, something that you made, like decided in your business, either recently or a long time ago, and change it. And so you have to be, I think that's the same, Jason, with any kind of acquisition, right? Like whether it's a strategic buyer, private equity, or ETA, the reason they're buying your business, at least they might not say this, but on some level, they want to make changes, right? So being
Yeah, so,
comfortable with that idea.
no doubt about that. And look, anyone selling the business, people who buy the business is because they see an upside, right? They
Yeah.
see something that maybe you're not doing that
That
they
they're
could
not
see.
seeing. Yeah.
And if they did this, it would be more profitable, be bigger, whatever it might be.
Yep.
That's true. And I think anybody selling the business, that's the biggest thing is like, oh my God, this is my baby and you're changing it. But when you're owner financing, does that change a little bit? Because you're carrying the paper. Now, some of these decisions that they make
Affect you.
could directly affect you.
Yeah.
Thoughts on
Yeah.
that, John?
Well, it's you've hit the nail right on the head, Jason, in the sense that it's exactly that. You may be sitting on the sidelines as a debt holder, watching the current owner make decisions you would not have made, you
Yeah.
may not agree with, and you may have very little recourse. Worse, when and if the business starts to struggle financially, you're second in line to an enormous bank loan that's guaranteed by the SBA. So you can imagine sitting behind Wells Fargo or JP Morgan Chase or whatever, they've got to get paid back before you see a dime. That's a tough spot to be in. Watching what effectively is a train wreck in front of you, knowing that you would know how to fix it, knowing that you could fix it. Just give me the ball, coach. Give me the ball. You're on the sidelines, not able to do anything. And it can be very frustrating. So again, I hear myself talking, thinking I sound negative. I don't mean to, and I don't mean to sound
Look,
negative.
we
I'm
could
just
we could
saying,
talk about the pros and cons of private equity because
yeah,
Lord knows there's plenty of them. You know,
yeah,
this so everything has its pros and cons.
for
So,
sure.
and I hope the audience who's listening to this understands that you just gotta get involved with a process that you're willing to tolerate that risk or that issue with any scenario.
Yeah,
Period.
for sure, for sure. So, maybe you try to get away with 20% vendor financing instead of 40%. Or, maybe you kind of narrow that down so that the cash you're getting up front is enough that even if it goes totally pear-shaped, that you wouldn't look back with regret on selling your company. Like maybe there's some situations like that. Um, but it is a risk, and you're right, Jason. It's a risk in any transaction.
All right. So bringing this full circle, if you had to say, just give it your punch list, pros, cons for people
Yeah,
to pay attention. Give me the pros, give me the cons. And if you feel go with the con first so you could end it on a positive note, whatever you want, because I know you're not negative about it because you're actually kind of positive about it.
yeah, yeah.
It's another way to sell your business. So it can't be a negative.
Yeah, yeah.
It's another way that a business owner can exit their business and get paid for what they built. So it's
That's
a good
absolutely
thing,
right.
but there's risks that go along with it.
Yeah, for
Pros and
sure.
cons, John.
So pros, for sure, liquidity for a business that may not have a lot of options. Number one. Number two, I think pro is that you're not selling to the evil empire. You're selling to an individual who you can look into the whites of their eyes and evaluate them. Many times you can see if there's cultural alignment, if they're kind of aligned with you philosophically, spiritually. Like you're like, yeah, this is someone I would love to carry on my business. Sure, they're going to change it, but I would be proud to see it in their hands. So that's a benefit. They're not generally financial engineers, right? They don't have a spreadsheet trying to squeeze every dime out of your business. They generally want to run your company. And in many cases that's for decades. And so it can be a way, to see your company continue to thrive under someone else. And that's like watching your kid go off and get married or go to college. I mean, it's sad on one level, but it's also incredibly
No doubt.
exciting to see them become adults and thrive on their own terms. So that's all pro. I think the cons, we've touched on briefly, but being aware that this may be their first time, so kind of doing some due diligence on the back end, and knowing that when you agree to take seller financing, you're going to sit behind a bank, so you got to feel confident that they're going to be able to execute. And so doing that two-way due diligence, I think, is important. That's essentially what I would say are the kind of pros and cons.
Fantastic. Really insightful, very helpful. There's a certain percentage of the audience for sure going, had no idea about this. And so really appreciate you bringing it to us, John. For us to have an expert like you share their thinking is just really amazing. So appreciate you. So listen, I'm going to ask you one last, I'm going to ask you one last question. And I try to keep it so it's more of a fun thing. And if there was one skill, and I want it not business related,
Okay.
one skill for John Warrillow that you would love to master outside of all your business thing, what is the big thing that John Warrillow would love to master?
I would love to become a better tennis player. My wife, Jason, is better than me, and it makes me crazy. So I would love to really, I'd love to be a kind of an A-level player, like tennis player who could, play on a club team and tournaments. I've never been that, and I've always sort of aspired to that. So maybe that's my next chapter.
All
But
right, I
right
appreciate
now, I'll
that.
have to
That's
succumb to
great.
watching my wife beat me every time we play.
Yeah. Mine is going from being a terrible guitarist to something that's
There you go.
not at least horrible.
There you
Not
go.
at least horrible.
Listen, a guy with a guitar at a campfire is like a very, that's a precious
I
resource. So I
agree.
think go for it.
All right. Well, everybody, that brings our conversation today to a close. John, thank you. Thanks for joining us. Thanks for sharing your expertise. It's a pleasure. Always is
Love
a
the TAP
pleasure. So
community,
thank you
Jason. It's
so
always my
much.
pleasure. Yeah, no, it's
So
my
to
pleasure.
everybody listening today, I hope that you're able to walk away with some really good insights that maybe, if appropriate for you, you can put into practice and could lead to a greater purpose and confidence for you as a business owner. And with that being said, as always, please be well, be safe, and most importantly, please be kind. Take care, everybody. Appreciate you. Thanks, John.